Green Supply Chain Insights, hosted by Finboot's CEO, Juan Miguel Perez.
Hello, everyone, and welcome back to Green Supply Chain Insights. I'm Juan, and while the summer in Europe is usually a bit of a quieter time for policy and markets, a couple of developments over the past few weeks are worth our attention. Today, I want to focus on two stories that, if you follow me on LinkedIn, which I definitely hope you do, you may have already seen me comment on. If not, don't worry, we will dive deeper into them. But if you enjoy this type of content, make sure you connect with me there as well. Today, we're talking trade wars and sustainable finance. Initially, they might seem like two separate issues, but you'll see they quickly intertwine. First, the recent EU-US trade deal briefly spun as a win for Europe before the narrative quickly shifted towards caution, restraint, and the broader good after the initial backlash. Frankly, I understand the need to politically sugarcoat this, but the reality is that it is a strategic step backwards for both the EU and for the green transition. Now, don't worry, this episode won't be all doom and gloom. Our second topic is a positive market signal, a shift in capital flows away from fossil fuels. But let's start with the trade deal. The EU-US trade deal. On paper, this agreement aims to strengthen transatlantic trade, though it wasn't exactly weak to begin with. But here's what it actually means. EU export tariffs to the US have increased from around 5% to 15% in most manufacturing sectors. The EU has also committed to new public spending on US imports of fossil energy and defense. So in very simple terms, European exports will become more expensive for US consumers, and the reliance on costly energy imports will drive up manufacturing costs here in Europe, weakening our position whichever way you look at it. And since the announcement, Trump has already threatened the EU with higher tariffs if these spending commitments aren't met. Now, some of these commitments include over 600 billion euros in energy products over the next 3 years, notably imports of liquefied natural gas and crude oil. In other words, we're locking ourselves into fossil imports again at the very moment we should be doubling down on renewables. This comes while Europe's gas consumption has been in a steady decline, over 20% lower than 2019 levels. A trend that was accelerated by our need to cut the dependence on Russian gas. Yet, here we are, seemingly learning nothing from that experience, weakening our energy independence once more by increasing reliance on another foreign supplier. It's part of a broader trend by the EU Commission that I find quite troubling, which is short-term deals that undercut long-term strategy. Thankfully, as I had said before, it's not all bad news. Oddly enough, the financial sector is driving some positive trends. There's been a shift on Wall Street. According to Bloomberg, fossil fuel deal-making has dropped sharply in 2025. Financing for oil, gas, and coal projects by the 6 largest banks in the US fell 25% through August 1st compared to the same period in 2024. This is surprising given that these same banks started the year by leaving the Net Zero Banking Alliance, a UN-convened coalition launched at COP26 in Glasgow in 2021, aimed at aligning lending and investment portfolios with net zero emissions by 2050. At the time, their exit was widely seen as caving to political pressure, coming just as Trump began his second term. We fast forward 6 months, and despite the retreat from the public commitments, their actual capital flows are shifting away from fossil fuels. Now, why this gap between the rhetoric and reality? Well, from my perspective, rhetoric is more vulnerable to political cycles, while capital allocation, on the other hand, responds to fundamentals. Fossil energy is still profitable, no questions there. But it's volatile and it's geopolitically exposed. The risk profile was once acceptable when fossil was the most profitable and least risky option. But the tables have turned. Clean energy technologies are increasingly scalable and they deliver stable, predictable returns. These assets are also aligned with forward-looking regulation, especially in markets like the EU. Put simply, investors are seeing the long-term risk-reward profile tilt towards cleaner assets, with the added benefit of shedding the political and moral baggage of fossil fuels. Now, it's a positive signal, but we are still far from where we need to be. The International Energy Agency says we need a 4-to-1 ratio of clean to fossil investments to hit the net zero by 2050. We are at about 1.7 to 1. That's the gap that we need urgently to address, and one of the key metrics that are worth tracking. Enter sustainable finance. Enter sustainable finance. This shift in capital flows is a perfect entry point into sustainable finance. The practice of directing investments and loans towards activities that protect the environment, support social well-being, and deliver financial returns. One of the most widely adopted tools in this space is the sustainability-linked loans, or SLLs. SLLs tie financing terms, often the interest rate of a loan, directly to a borrower's sustainability performance. The better you perform on agreed ESG targets, the cheaper your loan becomes. They can incentivize suppliers to improve metrics like carbon footprint reduction, renewable energy use, diversity in leadership, and supply chain transparency. For example, a manufacturer might secure a lower interest rate by cutting Scope 1 and Scope 2 emissions by an agreed percentage. Or a retailer could commit to sourcing a set share of deforestation-free products and receive better financing terms for meeting that target. Why does this matter for supply chains? Well, because finance drives behavior. When the cost of capital is linked to sustainability outcomes, you create a tangible incentive for both buyers and suppliers to act. You combine that with capital markets shifting towards cleaner, lower risk assets, and you can see how finance can accelerate the transition. In the coming days, I'll release a special interview where I sat down with Giulia Borsa. Giulia is a sustainability leader with deep ESG finance expertise and the EMEA lead for Gravity, a platform for carbon accounting and energy management. We will be diving deeper into how ESG is becoming financially material for companies, how SLLs are influencing supplier behavior. We'll bring you through examples of ESG performance translating into financial advantages and the role of digital tools in improving ESG data reliability. So consider today's episode the warm-up and be sure to catch that conversation when it drops next week. Final thoughts on today's episode. On the trade deal, don't get distracted by the headlines or the short-term political wins. Stay focused on the long-term strategy. On capital flows, watch where the money is going, not just what institutions are saying. This year has shown us that they aren't always aligned. And on sustainable finance, 2025 could be the long-awaited inflection point where tools like SLLs can make ESG targets financially material and accelerate investment in green assets. That's it for this peak summer edition of Green Supply Chain Insights. If you found today's discussion useful, please share it with your network. Remember, episodes drop every month, followed by a LinkedIn article. You can find them all on my profile on Finboot's YouTube channel or going to finboot.com/insights. Thanks for listening and see you next month.